Hey, Andy. Let's talk about 401k rollovers. Now, I'm going to be mentioning the word 401k a lot, but I'm really talking about employer retirement plans in general, which could also apply to 403bs if you have one, such as if you're a teacher or a public employee, a 457 plan, which is also typically a public or municipal employee plan. If you're a federal employee, the TSP or Thrift Savings Plan, also 401As, which are less common, also typically for public employees or teachers, for example. So, generally speaking, when you retire from your employer or you leave to go to another employer, for example, you have the choice of leaving your money behind at whatever 401k or employer retirement plan you have, or you can take it with you. Now, by taking it with you, if you go to another employer, you can roll your old plan into your new employer's plan if you want, or if you're retired, you can take the money out. Well, I shouldn't say take it out. You can roll it over into an IRA or a Roth IRA if you have Roth money in your employer plan, or you can actually take it out in the form of a distribution where it's just straight out, paid to you, taxes will be withheld, and it's going to be reported as income that year. But if you roll it over into another qualified plan, such as another employer's plan or your own IRA or Roth IRA, there typically won't be any tax in doing that. So you're simply rolling it from one pre-tax account to another pre-tax account, or if you have Roth money in your employer plan, from one Roth account to another Roth account, and that's not a taxable process if and when you do the rollover correctly. So I want to talk about how to actually do it. Now, I don't have screen shares to show because depending on your particular employer and the administrator of your retirement plan, it may look and feel potentially very different, but the basic steps involved are as discussed now. So it's not like a regular brokerage account where you can do a transfer by initiated through the new broker you're going to. Employer plans like 401ks are different. You have to initiate the process at that plan administrator. So for a 401k, there's a few ways you can do it. Again, depends on the particular administrator. Sometimes you can do it through their website, where you can do the whole process right there. Sometimes you have to call them up verbally to do it. Sometimes there's a form that you may get from them either through the website or by calling them. So it really all depends. But the ultimate point is you have to initiate the process of rolling over the money out of your 401k through the plan administrator, or contact your HR department if you don't know how to do it through the plan administrator site itself. Either way, you'll ultimately get there. And then when you do the rollover, assuming you are rolling it into another 401k or an IRA or something, you're not taking a straight up distribution, the wording of how the money is or to whom the money is made out to matters. Now, in most cases, when you do roll over a 401k into an IRA or something, or another employer plan, it'll often be on a paper check. They will liquidate what you have inside your employer plan, send you the cash proceeds on a paper check. Sometimes it has to go to you, to your home mailing address, or sometimes they can mail it direct to the receiving institution, whether it's another broker or another 401k administrator. But the important thing is the check will not be made out to you personally. It'll be made out to the custodian of the new account it's going to for the benefit of you. So for example, if you're rolling into an IRA at TD Ameritrade, let's say, the check will be made out to TD Ameritrade for the benefit of John Smith IRA, or fill in your name, whatever it is. Ideally put the IRA account number in there too. It is not made out to you directly. If it is, that's a straight up distribution, which is not what we're talking about. This is rolling over from one qualified retirement plan into another. So that's the basic process. Don't be surprised again if it is a paper check that they have to mail, and don't be surprised if it has to come to you. Again, it's not made out to you, but the check is sent to you for you then to have to turn around and mail it to the receiving institution. Super clunky, super archaic. I don't quite know why a lot of plans don't allow for some sort of more expeditious way to get it there. Some custodians will allow you to wire money from the 401k into your receiving account. I personally had 401ks that did allow that. I've had others that didn't, where they did have to mail me the paper check. Go figure. So that's the basic process. Again, it may be you can initiate it all through the website, or you have to call, or there's some form you either get through the website or through calling, or if all hope is lost, just contact your HR department. They'll be able to figure out or give you the steps of what you have to do next. I mentioned this is in reference to 401ks, which is private employer plans. If you have a 403b, if you're a teacher, for example, sometimes there's additional steps involved. In addition to initiating the process through the custodian, the administrator of your 403b, there sometimes is another third party involved. I don't want to say affiliated with the school district, but an independent organization. That's not even the right word. There's another, it's the plan isn't just between you and the custodian. There's another overseeing entity organization that's also involved in this mix. So I've done a few 403b rollovers where you have to first get approval from that third-party organization, then send that approval to the actual custodian of your 403b. They then release the money, via check typically, that you then deposit to, wherever it's going to. If you're a federal employee and have the TSP or Thrift Savings Plan, there's a specific form, I forget the exact number, but there's a specific form you have to use to request a rollover. If I remember correctly, it may have to be notarized as well, or maybe it was just if you have a spouse, you have to notarize it. But check with your HR. This happens all the time. They'll be able to walk you through what that form is, how to find it, how to fill it out, and what's required. If you have another plan like a 457, again, just check with your HR. The process will be loosely similar to a 401k, in that you probably have to fill out some form. You may not be able to do it direct through the website, but just check and find out and go from there. So that's the basic process. Now, I mentioned Roth before. By default, I'm assuming your plan is just traditional pre-tax money that you got tax deductions for, or tax deferral, I should say, when you made the contributions, and any matches you may have in there, and any growth on your contributions is all going to be pre-tax as well. So that stuff will all go to either another 401k or 403b or whatever if you're rolling to your new employer, or to a traditional IRA. If you do have any Roth money, so a lot of employers now allow Roth contributions to be made to the plan where you don't get a deduction for it, but that money will all eventually be tax-free, including the growth thereon. You can split that out and roll that to a Roth IRA. Or if your new employer similarly has a Roth option, you can split that out and roll it there. So what happens is, if you have a 401k that's, let's just say, $1 million in total, let's assume 100,000 of it is Roth money, the other 900,000 is traditional pre-tax money. What happens is, when you roll it out, the plan administrator will have the record keeping of how much is Roth versus how much is traditional. They will, in effect, they will cut you two checks. There'll be a $100,000 check made payable to your Roth IRA, and then the $900,000 check made payable to your traditional IRA. If you're rolling to IRAs, or if you're rolling to your new employer, same thing. It'll be, this much is going to your Roth part of the new employer plan, and the remainder is going to your traditional pre-tax part of your employer retirement plan. That's it in a nutshell. There's a few things to watch out for in terms of why wouldn't you roll over. Typically, rolling over does make sense, whether it's to your new employer plan or if you retire to your IRA, for a handful of reasons. One is simplicity. Why have a gaggle of accounts floating around? It's different logins to have to keep track of. When time comes for you to take required minimum distributions, which under current legislation is the year you turn 72, each 401k, each employer plan you have will require its own required minimum distribution. Whereas if you roll them all into just an IRA, then there's only going to be one required minimum distribution you have to take just from the IRA. You don't have to worry about monitoring and taking RMDs from the different accounts. So there's that. Basically simplicity. Often lower fees. Employer plans cost money to administer, and all else equal, the smaller the employer plan, the chances are the higher the fees are. So you can almost always do better in terms of fees with regards to the expenses of the funds in which you invest, and the expenses of the plan as a whole are usually lower if you roll it out to an IRA, because most IRAs have no fees to open or maintain the accounts, and you have virtually endless amounts of investment options you can choose. So you can easily find really good, really low cost investments when you invest through an IRA versus your employer plan. Will have some element of fees that are probably higher than the IRA. Now, in my experience, the best in terms of lowest cost, easiest, most simplest retirement plan I've seen is the federal TSP or Thrift Savings Plan. The fund expense ratios are really low. There's a handful of funds available to you that are index, passive based funds, but you can still do better in an IRA from a fee perspective. You can get investments in IRAs that are identical or close to the fund options in the TSP, and for slightly lower expense ratios too. So for as good as the TSP is, you can still replicate it and do slightly better from a cost perspective in an IRA. So that's some reasons why you would want to roll. I have a video about it. I'll put a link in the bottom, pros and cons of 401k rollover. Reasons why you wouldn't want to roll necessarily. The biggest one with regards to 401k is something called the Rule of 55. I also have a link to that in the notes of this video. Basically says, if you're younger than 59 and a half, there's typically a 10% early withdrawal penalty if and when you take money out of pre-tax plans like 401ks or IRAs. But there's something called the Rule of 55 with a 401k that if you retire from the company in the year you turn 55 or later, you can access that employer's 401k. You can take distributions without penalty, without the 10% penalty. You still have to pay tax, but you can avoid the 10% penalty if you're younger than 59 and a half and older than 55. So check the video for more details. But that's really important. So if you retire at 57, let's say, and you're going to need to access the money in your 401k, you almost certainly do not want to roll it to an IRA, because once you do, you then lose the ability for the penalty-free withdrawals prior to 59 and a half. But by keeping it in the 401k, using the Rule of 55, you can access that money to take distributions out without the 10% penalty. So that's a big one. Again, fees, like I said, always shop around for fees. If your 401k is good, especially the TSP, the Federal Thrift Savings Plan, as I mentioned, really low fees. Not to say you can't do better in an IRA, but watch. If you're hiring an advisor and he or she recommends you roll out your TSP into an IRA for them to manage, be certain you know what they're going to invest you in and check the fees of that. It's really hard to beat the quality and simplicity of the TSP's fund options, especially considering the fees. So have that discussion with an advisor before he or she recommends you roll the IRA out, or roll the TSP out, and just confirm what are you going to be investing in and why. Explain to me why it's better than what's in my TSP. Important to know. So that's a few things to consider. Again, check out the videos below for more information. I will stop it there, but hopefully you found this helpful about how to do a 401k rollover. Take care. Thanks.